Hello, Brenden Rendo from NextHome Neighborhood Realty, and I'm joined today with Joseph Dionne of Appli Home Loans. And we're addressing today one of the biggest questions we're getting out there, which is how does a 2-1 buy down actually work? And is it beneficial for me as a buyer? But not only that, is it beneficial for the seller? So, Joe, let's get into it.
Absolutely. Thanks so much for having me here. And really, I'm talking on the lender side, so I'm talking exclusively from the buyer, right?
Mm-hmm.
Anything that's going to help the buyer is going to be good for the buyer in some context. But
Mm-hmm.
what is a 2-1 buy down? A lot of people have been saying, what is it? How does it really work? Is it really a lower interest rate? And basically, what it is if you take your interest rate that that you're actually closing at for your first year, 2-1 basically means for year one, your interest rate is 2% lower than what it would be regularly. And then
Mm-hmm.
year two, it's 1% lower than where it would be regularly. And then
Mm-hmm.
year three, it's right back to where it's supposed to be. So if
Okay.
your interest rate's a 7.25, year one, it would be a 5.25. Year
Okay.
two would be a 6.25. And then year three, it's back to 7.25.
Okay. Well,
So
let's take a look and let's show the users some of the savings that they can see if they choose to go with such a program.
absolutely. So I do want to double check here. We got loan amount of 450,000, but purchase price of 400,000.
Actually, let me fix that. We're going to do 380,
Okay, so we're gonna do
5%
5%.
down.
So this is the cool part, right? Like because people go, how much does my interest rate really impact my payment? And this is something a lot of people that are in the housing market have been wondering about. And you can see here that immediately at that 7.25, that monthly payment, that 25.92, that's principal and interest payment. Like that's not anything out. That's principal and interest payment. And if you go down just below on that 2-1 buy down, that 5.25 is a $493 savings a month. Like
Wow.
that's huge. So in that first year, that saving is almost $6,000, $5,926.
Okay.
And then year two, the rate goes to 6.25, but you're still saving $252.54. Now, some people have asked, well, wait a minute, like why isn't it just half of 493? Like why isn't year one savings 500 plus dollars? We got to remember
Hmm.
is you're paying down some of that principal too over
Yep.
that first year. So there's a little bit of a calculation there. But that second year, you save $3,000. So over the 2-year period, you're saving $8,957 in interest payments,
That's
and that
huge.
and that's huge. Now, I've talked to buyers and they go, well, I want that. And they're like, well, can I contribute to that? What can we do? It
Hmm.
has to be a seller contribution. It cannot be you.
Okay.
First off, I don't know if I would advise someone to be like, hey, spend 9 grand of your own money. Like I would say, just keep it in the bank. And if you want to make that extra payment, you can.
Okay.
Um, but the reality is it's a dollar for dollar cost that the seller is making. So if that savings, that 2-year savings for that 2-1 buy down is $8,957, the seller would be giving you a credit as the buyer, and it would be going into an an escrow account. And every month, the mortgage servicer would be paying from that escrow account, collecting that little bit of money for that savings, so that you're not responsible for it.
Okay. Okay. So it's actually a separate account
Yeah.
that it's kind of like the seller's giving you money to prepay your interest in a way.
Bingo. That's exactly what it is. The seller's just giving you money to prepay part of your interest, which is keeping your monthly payment down. Now, the big thing that we hear is people go, awesome. So I qualify for more home because I'm doing a 5.25 now.
Yep.
No, that's not the case. You qualify based off the actual rate that you close at, which is 7.25 in this
Okay.
example. So
Which
that's
that's a
where
big
you're.
question because you see a lot of news out there that, oh, people are starting to get into risky mortgages again. So
Yes,
you're really not getting into a risky mortgage at all because you're actually qualifying for what you truly can buy to begin with.
exactly.
And then I guess the benefit to this is everyone's kind of got their crystal balls out and are predicting well, the Fed's going to have to pivot and rates
You,
are going to come down in the next year or so.
you hit it on the dot right there, right? Is a lot of people are thinking rates are going to go down, right? And
Hmm.
that's the hard part is, well, do I wait for rates to go down? And the challenge is in all of this is, a lot of people like we kind of go into the thought process before of, well, well, at some point the housing market's gonna slow down and prices aren't gonna go up. Hasn't I mean, now they're not growing to where they were, but we're not seeing that crazy rebound that everybody was thinking was going to happen,
Hmm.
right? Conversely, rates will go down, but do you want to continue to wait? Like, you can get into this product, and most industry forecasters, like not myself, I'm not saying I am, but I tend to say, like, I'm going to leave the experts that's what they do all day, and that's what they're paid big bucks to do. I'm going to
Hmm.
follow their direction. They're all thinking sometime in the next, I'm seeing as early as 6 months from now, and I'm seeing as late as like 18 months, they think rates are going to go down.
Okay.
Well, in that situation, a 2-1 buy down is perfect. And here's the cool part. Let's say you refinance in a year and you still have $6,000 or $3,000 in that escrow account. It just
Hmm.
goes to a principal reduction to your new
Okay.
mortgage. So you
Oh,
don't
that's
lose
nice.
that money.
That's nice. Now, what type of loans can we use this product on? Is there limitations?
There are some limitations. You cannot use this on investment products, but on conventional, I can do it for primary and secondary. For FHA, I can do it, and I can do it on VA. So those are kind of the products right now: primary home, FHA, VA, conventional, or secondary home on conventional.
So that's going to cover 95% of the people out there.
95% of the people, absolutely.
Fantastic. So really, as a buyer, I these days I kind of want to look at this product.
It's a really cool, and the cool part is it doesn't add any underwriting time. It's no special scenario. You fill out an addendum, you get the credit from the seller, and that's pretty much it. We handle the rest.
Excellent. I mean, that's a lot. That's a lot of savings. And we know from doing our numbers on a weekly basis that there's room in there these days to go back and ask a seller for this.
Absolutely. So I'm
Yep.
curious though, like, I'm looking at it purely from a buyer perspective. What's that seller perspective look like? Is it really beneficial for a seller?
Well, that's a great question. And with the market the way it is today, it can be a very big benefit for them.
Hmm.
Instead of looking at a price reduction, looking at giving the concession. What I
Okay.
did is I worked up our numbers, based on the exact same loan scenario that we had looked at, where we were doing a purchase of $400,000
Okay.
and going through the net. This is where we still sold it at the higher price of the $400,000, but we
Yeah.
gave our buyer the concession, worked with you,
Hmm.
said, okay, this is how much he needs, to do the 2-1 buy down. So we kept it at the same scenario. And as a seller, I would net $257,000.
Hmm.
Now, say I had to come back and we're sitting there, we're looking at things, we're not getting a lot of showings, and an agent is saying, well, we're going to need to cut the price. And most of those price cuts these days are roughly running, 4 to 5% when they do
Hmm.
a price cut. So you look at that at a 5% price cut, dropping our price to 380,000, not giving any concessions,
Hmm.
my estimated net drops to 248,000. I lost roughly $9,000
Yeah.
in net.
Yeah. Because they're paying $20,000 less. They're getting 20,000 less versus on the 2-1 buy down, they're only having to give 9 grand in concessions.
Yep. And you look at that from a seller's perspective, it's a great way to keep up my net up, but also we're using the equity that's been built from the increased prices. The
Hmm.
houses are still going to appraise.
Yeah.
The houses are still going to appraise. So it's going to help keep sales prices up where they currently are. And
Yeah.
it really turns out to be a win-win situation. And that's what you're always looking for in a
Yeah.
transaction. Make it a win for the seller, make it a win for the buyer, come
Hmm.
to a meeting of the minds, and boom,
Yeah.
let's get this transaction done.
And I mean, like you said, like, a 20 grand price reduction for a buyer may only net them $60 to $70 in monthly savings.
Hmm. Which
So You could be looking
Here's
at
another great
almost
point. Yeah.
$500 in monthly savings for the first year, 250 for year two. Like that's a big saving. It's going to take a while to see that break even point of that price reduction. It may
Yep.
be, you're talking 8, 9 years before there's that break even, which how the average consumer is only in their mortgage for 7 years.
Yep. Yep.
Like I think right now, like this 2-1 buy down and the big macro type scenario is it helps keep prices where they are because now we're not seeing a race to drop prices, which is what we
Exactly.
want. We want to see that housing market stay stable because everything else is tied to it. The
Exactly.
entire
Yep.
economy churns based off of this housing market.
And so far here in Orlando, we're holding steady, which is
Awesome.
wonderful to see. So, well, thank you everyone for your time. If you have any questions directly about the 2-1 or you want to run a scenario, we'll actually put a link to the spreadsheet down below, or call Joe or call myself. Reach out. We're here to help you and answer any questions you have. Have a great
Awesome.
day.
Thanks so much, guys.
Take care.